Hi there, my name is Mary Salisbury. My company is The Right Divorce Solution located in Wilmington, North Carolina. I'm a divorce mediator and a divorce financial planner, and my mission is to help people divorce with grace, to help them divorce in an emotionally healthier manner, and to help them divorce in a financially smart manner. So today I want to talk about insurance in divorce. Specifically, I'm going to be talking about life insurance and disability insurance. Because if you are someone who is going to be receiving spousal support or child support, or maybe in your divorce decree, you're going to be receiving a stream of payments, probably through, say, a promissory note, you're going to want to make sure that those payments continue to be made in the case that your ex-spouse dies or becomes disabled. Because if they stop or they're reduced, that is going to significantly affect the lifestyle of both you and your children. So life insurance is something that most attorneys think about when they're working with their clients. It's not uncommon to see that in a divorce decree. Hopefully the person who needs the insurance, the supporting spouse, is insurable. And if they are insurable, that's great news. And if it's affordable, that's even better news. And what happens is that they will approach an insurance agent, and that insurance agent will approach the insurance companies, and hopefully they can find a policy or insurance company that will write up a policy where the face value of the insurance policy decreases as the years go by, because the obligations of the supporting spouse are going to decrease as the years go by. I mean, the amount that the present value of a stream of payments for when let's say your child is 5 and you have to support them until they're 18, that's going to be a whole lot bigger lump sum amount than it will be when that child is 15. So you want to ideally have a face value on your insurance policy that decreases as the years go by, so that your premiums also decrease as the years go by. So, that's great if you can write up a new policy. Another, possible approach is to get a few different policies that are staggered. So they're either staggered in the amount that the face value is, or they are staggered as in the number of years that they cover, so that as obligations go down, you may be able to stop paying on a certain policy and just drop it because you no longer need to insure X amount, and so you don't need that policy anymore. So those are two approaches to be able to decrease the face value that you're having to pay for. What often happens though, somebody is either uninsurable, which is terrible, or they have an existing life insurance policy, which hopefully if you have children, you have bought a life insurance policy. So the problem with a life insurance policy that exists is that it can't be split. So say you have a present value of support obligations that is equal to $250,000, but you have a life insurance policy that has a face value of $500,000. Well, you're not really going to want your the spouse that's getting the support to get a windfall when you die of that extra $250,000 just because there's a life insurance policy. You may, but a lot of people won't. They'll want to give that that other amount to another family member, or maybe go directly to the kids, for their life, their college or whatever. So what happens in this case is that there's going to have to be beneficiary designations written up, so that as the years go by, the percentage that the spouse that's getting, that would get the insurance premium, that needs the support payments, the percentage that she would get as that big lump sum life insurance proceed would decrease as years go by. So maybe in year 1 she might get 100%, in year 2 she would get 90%, year 3 80%, and as the years go down, the amount that she would get out of the proceeds would decrease. So that's one way to handle it. But the problem is that there's a lot of trust involved in that, because who knows if that beneficiary is getting changed. Only the owner of the policy is able to make the beneficiary designations and change them, and they're the ones that really are the ones that know, if the beneficiary designation is correct. It can be written and should be written in the divorce decree that, as the years go by, every year you're going to write up a new beneficiary designation, and, we're going to provide proof that this has been done, and hopefully, people are nice and they abide by that, and everything's, done the way it should be. Another problem with, life insurance in general is only the owner knows if the insurance premiums are being paid. So sometimes what I recommend is that either the person who is going to be getting the support payments pays the premiums themselves, which isn't really fair if they're not getting 100%. They're not going to really want to do that, or maybe an agreement. You can't just pay 50%. Because who knows if the other 50% is going to be paid. But I think a better way to do it is that the spouse that is going to be getting the support actually becomes the owner of the policy. And that way, whoever is in charge of the premiums knows that the premiums are being paid. So if for some reason, the ex-spouse who is the insured stops making premium payments, she's going to get notification that those premiums are not being paid, and she can, get her attorney to do something about it, or start, make those premium payments herself or himself before, the policy lapses. So that's I think probably the smartest thing to do. And again, in all of this, there's a certain amount of trust involved, because possibly part of that part of those insurance proceeds may be going to somebody other than the person that is needing this stream of support payments. So but either way, hopefully, people are going to be civil, and they're just going to be above board and not be greedy, and everything's going to be done the way it should be. So the next thing I want to talk about, though, is disability insurance. Now, disability insurance is often overlooked, and it's said that in the period that someone, the age group that someone may be making spousal support and child support, it's 4 times more likely that they're going to become disabled than they are to die. Yet a lot of times, disability insurance isn't even thought about. A lot of times, white-collar workers or professional or technical workers will have a disability policy at their workplace. But the problem with that is that it will only cover maybe 40 to 60% of their income. And so now, they're disabled and possibly have a lot of medical bills, and they're faced with the reality that they can't make these support payments. And so what do? They can go back to court and petition the court to reduce the payment obligation, because now they're disabled and they don't have that income. But the problem is that takes a lot of time. It can take months to get on the calendar, and you have to pay an attorney to be able to do that. Often you could try to do it yourself, but usually you're going to have to hire an attorney, because the system is complicated in that way, it's set up to be that way. So you're going to have to hire an attorney at a time when you can't even afford to make your spousal payments, your child support payments. So you're in a real predicament. And meanwhile, the person that's needing that support is either not getting it, or they're getting it in a reduced amount. So, everybody, no one's winning in this situation at all, and it's a really bad situation. You can possibly be getting workers' comp if you were injured at work, but that also is not going to, be the same amount as what you're getting paid. Or you could file for Social Security disability, and again, that doesn't cover the whole amount that you were earning before you became disabled. And, but probably they say about 70% of applications for Social Security disability get denied anyway. And a lot of times you end up having to apply an appeal, and that can take time. And meanwhile, again, these support payments, aren't being made. Sometimes people will end up having to liquidate assets, maybe sell their house, or to be able to make, these payments. So it's really a bad situation when there's disability and no one has thought of disability insurance. So unfortunately now there is a new product. Well, it's not that new, but it's something that, a lot of people don't know about, especially a lot of, family law attorneys don't know about this product. And it is divorce disability insurance. And it's really a great product. It's meant to only cover, these support obligations. So it's not meant to cover everything that the person that is disabled needs, for as far as their support. It's only meant to cover the support obligations under the divorce decree. So it's written in 5-year increments. So you get a disability policy for 5 years. Often because your obligations are going down during that period of time, the premiums are also going down. So these policies are meant to be a little bit more flexible than the traditional term life insurance is. And then at the end of those 5 years, you can write up a new disability policy to cover the next 5 years. And so you can do this. The premiums will decrease during that time, hopefully. And if say in year 8 you have no more obligations, well, you just quit paying the premiums on that disability policy. So these are, it's a really good product, and one that, since you have now listened to this video, that you're now educated enough to tell your family law attorney or your mediator or your financial person that's helping you with your divorce that you are interested in finding out the costs of these policies, life insurance and disability, so that you can be protected in your divorce, and you can maintain your lifestyle in case the worst case scenario happens, your ex-spouse dies or becomes disabled.